In January 1973, the Dow Jones Industrial Average stood at 1,051 points. By December 1974, it had collapsed to 577. The market lost 45% of its value. Trillions of dollars evaporated. Companies that looked invincible went bankrupt. Investors who'd been confident a year earlier were now panicking, selling everything they owned at whatever price they could get. Most people remember the 1973 to 74 crash as a disaster. Charlie Munger remembered it as an opportunity. While everyone around him was selling in terror, he was buying. While his colleagues were convinced the world was ending, he was calmly accumulating shares of excellent companies at absurd discounts. This wasn't because Munger was lucky. It wasn't because he had information others didn't. It was because he understood something most investors never learn. Market crashes don't destroy wealth, they transfer it. Money doesn't disappear during crashes. It moves from the panic to the patient, from the emotional to the rational, from the weak hands to the strong ones. By the time the market recovered, Munger had positioned himself to capture returns that would compound for decades. The investments he made during those 2 years of chaos became cornerstones of his fortune. Not because he was brilliant at timing, he wasn't trying to catch the bottom, but because he was willing to act when everyone else was paralyzed by fear. This is the story of how Munger approached the 1973-74 crash, what he saw that others missed, what he did while others panicked, and most importantly, what he learned about human psychology, market dynamics, and the mathematics of buying during chaos. Because the lessons from 1973 apply to every market crash that's happened since and every crash that will happen in the future. Market crashes are inevitable. They've happened dozens of times in the past century. They'll happen dozens more in the century ahead. The only question is whether you'll be one of the people who loses money during crashes, or one of the few who makes money from them. Munger chose the latter. And if you understand what he did and why, you can make the same choice when the next crash comes. To understand what Munger did during the crash, you first have to understand what caused it. The 1973-74 crash wasn't a single event. It was a perfect storm of factors that came together to destroy confidence in the market. The first factor was the oil crisis. In October 1973, OPEC imposed an oil embargo on nations supporting Israel in the Yom Kippur War. Oil prices quadrupled almost overnight. Gas stations ran out of fuel. Lines of cars stretched for blocks as people waited hours to fill their tanks. The economy, which had been built on cheap energy, suddenly faced the reality that oil was expensive and scarce. The second factor was inflation. By 1974, inflation was running at over 12% annually. Money was losing value so fast that people could feel their purchasing power declining week by week. The Federal Reserve tried to fight inflation by raising interest rates, which made borrowing more expensive and further slowed the economy. The third factor was the end of the post-war boom. The 1950s and 1960s had been decades of almost uninterrupted growth. The stock market had gone up year after year. People had started to believe that growth was permanent, that the good times would last forever. The crash shattered that illusion. The fourth factor was political chaos. President Nixon was embroiled in the Watergate scandal. He'd resigned in August 1974. The government seemed dysfunctional, untrustworthy, unable to address the economic problems. If you couldn't trust the government, what could you trust? Add it all together, and you had conditions that seemed apocalyptic. Energy crisis, runaway inflation, political breakdown, market collapse. To investors in 1974, it felt like the end of the American economy. Many serious people believed the country was entering a permanent decline. Books were published arguing that growth was over, that the post-war boom had been an anomaly, that Americans would have to accept a lower standard of living going forward. The mood was dark, not just worried, genuinely despairing. People who'd been in the market for decades said they'd never seen anything like it. The crash of 1929 had been sudden and sharp. This was a grinding, relentless decline that seemed to have no bottom. Every time you thought it couldn't get worse, it got worse. And that's when Munger started buying. Most people looking at the same situation saw nothing but risk. The economy was collapsing. Inflation was out of control. The political situation was unstable. Energy was scarce. Why would anyone with any sense put money into stocks? Munger saw it differently. He saw excellent companies being valued as if they were going bankrupt. He saw businesses with strong fundamentals, good management, and durable competitive advantages trading at prices that made no sense unless you believed the world was ending. And Munger didn't believe the world was ending. He'd lived through the Great Depression. He'd seen real economic collapse. This wasn't that. This was painful, yes. Disruptive, certainly. But it wasn't the end of capitalism or the end of American prosperity. It was a correction, a severe one, but still a correction. And corrections create opportunities for people who can keep their heads while everyone else is losing theirs. To understand what made Munger's actions during the crash so unusual, you have to understand the psychology that gripped most investors, because the decision to sell wasn't irrational in the moment. It felt like the only sensible thing to do. When the market is crashing, your brain is screaming at you to do something, to act, to protect yourself. Every day you watch your portfolio lose value. Every news report confirms that things are getting worse. Every conversation with friends and colleagues reinforces the message that you need to get out before you lose everything. The psychological pressure is immense. You feel stupid for still being in the market. Everyone who sold earlier looks smart. They preserved their capital. They're sitting in cash safe from the carnage. Meanwhile, you're watching your net worth decline day after day, and the voice in your head keeps asking the same question. How much more are you willing to lose? Munger watched intelligent, experienced investors crack under this pressure. These weren't novices or fools. They were professionals who understood markets, who'd made money for years, who knew intellectually that selling low was a mistake. But knowledge doesn't override emotion when the pain becomes unbearable. The pain of watching your wealth decline is psychological torture. Studies have shown that financial losses activate the same parts of the brain as physical pain. And just like physical pain, there's a breaking point where you'll do anything to make it stop. For most investors in 1974, that breaking point came somewhere between 20% and 40% losses. They sold not because they had a rational plan, but because they couldn't stand the pain anymore. This is what Munger understood about market psychology. People don't sell stocks because they think prices will go lower. They sell because they can't tolerate the uncertainty and the pain of current losses. They sell for psychological relief, not for financial advantage. The decision gets reinforced by social pressure. In late 1974, if you said you were buying stocks, people looked at you like you were insane. Financial advisors were telling clients to get out of equities. The media was full of experts explaining why stocks were going lower. The conventional wisdom was unanimous. The market was toxic, and any money left in it would be destroyed. Going against that consensus required more than just contrarian thinking. It required a willingness to be wrong in public. To have everyone, friends, colleagues, even your spouse, think you were making a catastrophic mistake. To face the possibility that the experts were right, and you were the fool who'd lose everything. Most people can't handle that social pressure. They'd rather lose money with the crowd than risk making money alone and being mocked if they're wrong. Munger didn't care. He'd long ago stopped making financial decisions based on what other people thought. If the math worked and the fundamentals were sound, he acted. Everything else was noise. But there was another psychological factor at work: fear of missing the recovery. This one trapped people in paralysis, even after they'd sold. They'd gotten out of the market, preserved some capital, and now they were waiting for a signal that it was safe to get back in. But what signal? When would they know the bottom was in? The answer is never. By the time you know the bottom is in, prices have already recovered substantially. The people waiting for certainty missed the recovery entirely. By the time stocks looked safe again, they'd already doubled from their lows. Munger understood this paradox. The time to buy is when it feels terrifying. The time everyone agrees stocks are safe is exactly when they're expensive. Maximum opportunity coincides with maximum discomfort. If you want the returns, you have to tolerate the pain. This is why Munger believed that temperament mattered more than intelligence in investing. Smart people could understand the analysis, but only people with unusual temperament could act on it when their brain and their social circle were screaming at them to do the opposite. Munger's approach during the crash wasn't to buy everything indiscriminately. He didn't try to catch falling knives or speculate on companies that might survive. His strategy was simpler and more disciplined: buy excellent companies at ridiculous prices. He focused on businesses with several characteristics. First, they had to have durable competitive advantages, what Buffett would later call moats. These were companies that dominated their markets, had strong brands, or possessed some structural advantage that made them hard to displace. The crash might hurt them temporarily, but it wouldn't destroy their fundamental business position. Second, they had to have strong balance sheets. This was critical. Munger had watched the Depression wipe out companies that were operationally sound but financially fragile. If a company was loaded with debt, a prolonged downturn could bankrupt it even if its business was good. He wanted companies that could survive years of difficulty if necessary. Third, they had to have competent, honest management. A great business with terrible management was a bad investment. Conversely, good management could navigate difficult times and emerge stronger. Munger looked for managers who'd been conservative during good times, who hadn't over-leveraged, who'd built resilient organizations. Fourth, and perhaps most important, they had to be trading at prices that built in a huge margin of safety. Munger wasn't trying to find fair value. He wanted stocks that were so cheap that even if he was wrong about the recovery timeline, he'd still make money eventually. One of his focus areas was media companies. Newspapers and television stations in particular had natural monopolies in their markets. If you owned the dominant newspaper in a mid-sized city, you had pricing power that was nearly impossible to break. These businesses generated cash consistently regardless of economic conditions. During the crash, some of these companies were trading as if their monopolies would disappear, or as if people would stop consuming news. Neither was likely. Another area was consumer goods companies with strong brands. People might postpone buying a car during a recession, but they still bought toothpaste, soap, and food. Companies like Coca-Cola, Procter & Gamble, and similar businesses had brands that represented decades of consumer trust. A market crash didn't erase that trust. It just created a temporary opportunity to buy these durable franchises cheap. Munger also looked at financial companies, though more selectively. Banks and insurance companies were being punished severely because of fears about loan defaults and investment losses. But well-managed financial institutions with conservative lending practices were buying opportunities. They'd been beaten down not because of their own problems, but because of fear about the sector generally. What Munger didn't buy was equally important. He avoided companies that were struggling before the crash. He avoided highly cyclical businesses where losses could compound for years. He avoided anything that required the economy to recover quickly for the investment to work out. And he absolutely avoided companies that were using accounting tricks or financial engineering to hide problems. His purchases weren't market timing in the traditional sense. He wasn't trying to predict when the market would bottom. He was simply buying whenever excellent companies hit prices that were too good to pass up. If they got cheaper after he bought more. He wasn't concerned with short-term price movements. He was building positions in businesses he expected to own for decades. This strategy required capital. Munger had been saving and investing conservatively for years specifically, so he'd have ammunition when opportunities appeared. While others had spent the boom years fully invested or even leveraged, trying to maximize every point of gain, he'd held back. He'd been patient, and now that patience was being rewarded with opportunities to buy assets at fire sale prices. The irony wasn't lost on him. The people who'd mocked his caution during the boom years, who'd criticized him for not being fully invested, who'd bragged about their returns, those people were now sellers, liquidating at the worst possible time. Meanwhile, Munger was doing the buying. Understanding Munger's strategy intellectually is one thing. Actually executing it while the market is collapsing around you is something entirely different. This is where most people fail. Not because they don't understand the concept of buying low, but because they can't force themselves to actually do it when it matters. Munger's execution had several key elements. First, he'd prepared psychologically long before the crash happened. He'd studied previous market crashes, 1929, the bear markets of the 1940s, the 1962 flash crash. He'd read about how people behaved during those periods, what worked and what didn't. He knew that when his turn came, he'd face the same psychological pressures that had caused others to sell at the bottom. This advanced preparation mattered enormously. When the 1973 crash started, It wasn't a surprise to Munger in any psychological sense. He'd expected it. Not the specific timing or the specific cause, but the general pattern of boom and bust. Markets go up, markets go down. Sometimes the down moves are severe. This wasn't news, it was inevitable. Second, he'd set up his finances to support buying rather than force selling. He had no margin debt that could trigger liquidation. He had adequate cash reserves to handle personal expenses for years without touching investments. He wasn't depending on portfolio income to live. This meant he never faced the nightmare scenario that trapped so many others, being forced to sell at the bottom to raise cash for living expenses or margin calls. Third, he had a specific shopping list prepared before the crash. He'd been watching certain companies for years, waiting for them to hit prices that made sense. He knew exactly what he'd pay for Washington Post or See's Candies or various other businesses. When those prices appeared during the crash, he didn't hesitate. The decision was already made. He was just waiting for the market to give him his price. Fourth, he bought systematically rather than trying to time the bottom. This is crucial. He didn't sit around debating whether prices might go lower. When something hit his target price, he bought. If it went lower, he bought more. He treated each purchase as independent rather than agonizing over whether he was buying at the exact right moment. This approach protected him from the paralysis that trapped other investors. They kept waiting for confirmation that the bottom was in, for some signal that it was safe to buy. But the bottom never announces itself. By the time it's obvious the worst is over, prices have already recovered substantially. Munger's approach meant he started accumulating early, sometimes too early, but he captured the recovery when it came. Fifth, he was willing to look foolish in the short term. Some of his purchases immediately dropped in value. Colleagues who knew what he was buying thought he'd lost his mind. The market seemed to be confirming that his buys were mistakes. But Munger had learned to separate his ego from his portfolio. Being right eventually mattered. Being right immediately didn't. Sixth, he kept detailed records of his thinking. When he made a purchase, he wrote down why. What made this company excellent? What price made it a bargain? What would have to happen for the investment to fail? These notes served two purposes. They helped him resist the temptation to panic sell when positions went against him, and they created a feedback loop for learning. He could review past decisions and understand what had worked and what hadn't. Seventh, he communicated clearly with his wife about what he was doing and why. This was critical, because his purchases meant their net worth was declining, month after month on paper. Nancy Munger needed to understand that this was intentional, not negligent, that they were buying during chaos by design, that the paper losses were temporary and the long-term strategy was sound. Her trust allowed him to stick with the plan when social pressure to change course was intense. The actual mechanics of buying were straightforward: calling his broker, placing orders, accumulating shares. But the psychological mechanics were brutal. Every purchase felt like throwing money into a fire. The market kept going down. His new purchases immediately showed losses. There was no positive feedback, no validation, no confirmation he was doing the right thing. Just day after day of watching positions sink further. Most people can't tolerate this. They need to feel smart right away. They need the market to validate their decisions quickly. Munger was willing to feel stupid for as long as necessary until eventually being proven right. Munger rarely talked about the emotional toll of buying during the crash. He preferred to present his decisions as purely rational, as if he'd simply calculated the numbers and acted without emotional involvement. But that wasn't quite true. He felt the pressure. He experienced the doubt. He had moments where he questioned whether he'd made a catastrophic mistake. In late 1974, with the market still declining and no bottom in sight, Munger looked at his portfolio and saw nothing but losses. Every position he'd accumulated was underwater, some significantly so. If you'd calculated his net worth at market prices, he'd lost a substantial portion of everything he'd built over the previous 2 decades. This is the moment where most investors crack, where the theoretical willingness to buy low meets the actual reality of watching your wealth evaporate, where the question becomes not "is this a good investment?" but "am I destroying my family's financial security?" Munger faced that question honestly. He went back to his analysis. Were the companies he'd bought still fundamentally sound? Yes. Were they likely to survive the downturn? Yes. Were they trading at prices that built in enormous margins of safety? Yes. Had anything changed about the long-term case for these businesses? No. The only thing that had changed was price. And price in Munger's framework was information about other people's psychology, not information about business value. Declining prices meant people were more scared, that was all. But knowing this intellectually didn't make it comfortable emotionally. He still felt the weight of seeing his net worth cut nearly in half. He still heard the voice of doubt asking whether this time was different, whether maybe the pessimists were right, whether the economy really was entering permanent decline. What got him through these moments was his study of history. He'd read about every major market crash in American history. He knew that at the bottom of every crash, the conventional wisdom had been that recovery was impossible. In 1932, serious economists believed capitalism had failed permanently. In 1942, people thought Hitler would win the war. In 1974, people believed American prosperity was over. And every single time, the conventional wisdom had been catastrophically wrong. The economy recovered. Stocks went back up. The companies that survived became more valuable than ever. The difference between people who got rich and people who stayed poor wasn't intelligence or information. It was the ability to act contrary to conventional wisdom when that wisdom was at its most convincing. Munger also had conversations with Warren Buffett during this period that helped reinforce his conviction. Buffett was doing the same thing, buying aggressively during the crash. They'd compare notes on opportunities, discuss businesses they were accumulating, and reinforce each other's contrarian thinking. Having a partner who saw the situation the same way provided psychological support that made it easier to resist the pressure to conform. But perhaps the most important factor in getting through the doubt was Munger's long-term perspective. He wasn't investing with money he needed next year or even in 5 years. This was capital he expected to compound for decades. And over decades, temporary market crashes were noise. They created opportunities rather than dangers. If you needed your money in the short term, the 1973-74 crash was a disaster. But if you were building wealth over 20 or 30 years, it was one of the great opportunities of the century. Munger had structured his life so he could take advantage of exactly these kinds of opportunities. He'd kept expenses low. He'd avoided debt. He'd maintained adequate cash reserves. All of that preparation meant he could buy when others had to sell. There were still dark moments, times when he wondered if he was being stubborn rather than rational. Times when the evidence seemed to support the pessimists. Times when he questioned whether his historical analysis applied to current circumstances. But he kept coming back to the fundamentals. Good businesses don't become bad businesses just because their stock prices fall. Strong brands don't lose value just because investors are scared. Durable competitive advantages don't disappear during recessions. If those things were still true, and they were, then current prices were opportunity, not danger. The hardest part wasn't making the initial decision to buy. It was sticking with that decision month after month as the market kept falling, as losses kept mounting, as everyone around you kept telling you that you were wrong. That required a level of emotional resilience that most people simply don't have. It required being willing to be wrong for as long as necessary, until eventually being proven right. The market bottomed in December 1974. Munger couldn't know it at the time. Nobody could. It only became obvious in hindsight. But sometime in late 1974 or early 1975, the selling exhaustion hit. Everyone who was going to panic had already panicked. Everyone who was going to sell had already sold. There were no more weak hands left to shake out. And then, slowly at first, prices started to recover. Not dramatically. Not with any fanfare. Just a gradual stabilization, then small upticks, then slightly bigger ones. By mid-1975, it was clear the worst was over. By 1976, the market had recovered a substantial portion of its losses. By 1977, most of the crash had been erased. For Munger, the recovery was validation, but not vindication. He'd never doubted the recovery would come. Only its timing. The fact that it came in 1975, rather than 1976 or 1978, was irrelevant to his long-term thesis. What mattered was that the companies he'd bought cheap were now worth substantially more than he'd paid for them, and they'd continue compounding value for decades to come. The psychological relief of the recovery was real. Seeing your net worth decline month after month is exhausting even when you intellectually believe it's temporary. When positions finally start recovering, the weight lifts, not because the money matters in the moment. Munger wasn't planning to sell, but because the validation proves you weren't crazy. Your analysis was correct. Your patience was justified. But the more important realization came later, as Munger looked back on the experience and understood what had actually happened. The crash hadn't been a threat to his wealth. It had been the foundation of his wealth. The investments he made in 1973 and 1974 at crisis prices became some of the best investments of his career. If there'd been no crash, he would have made steady, reasonable returns. Instead, the crash gave him the opportunity to buy exceptional businesses at once-in-a-generation prices. His returns over the next decade weren't good, they were extraordinary. And it was all because he'd been willing to buy when everyone else was selling. This is the fundamental insight about market crashes that most people never internalize. Crashes are wealth transfer mechanisms. The wealth doesn't disappear, it moves from the panic to the patient, from the emotional to the rational, from the weak hands to the strong hands. If you have capital and courage when others have neither, crashes make you rich. Munger watched many of his colleagues miss the recovery entirely. They'd sold during the panic, preserved some capital, and then sat in cash waiting for a clear signal that it was safe to get back in. That signal never came in a form they recognized. By the time stocks felt safe, they'd already doubled from the bottom. The colleagues who'd sold at 600 ended up buying back in at 900 or 1,000, locking in permanent losses. Others did even worse. They stayed in cash completely, convinced that stocks were permanently toxic. They moved to bonds, gold, real estate, anything but equities. They spent the next decade watching stocks compound while their safe assets went nowhere. They'd let one painful experience convince them to abandon the best wealth-building asset class available. Munger had a particular disdain for this outcome. These weren't stupid people. They'd understood that stocks were a good long-term investment before the crash. But one bout of pain had caused them to abandon that understanding entirely. They'd let emotion override analysis, and it cost them decades of compounding returns. The lesson Munger drew from the recovery wasn't "I'm smart for buying low." It was having the right temperament is more valuable than having the right analysis. Plenty of people understood intellectually that stocks were cheap in 1974. Most of them still couldn't bring themselves to buy. They knew what to do. They just couldn't do it. That gap between knowing and doing, between theory and practice, is where fortunes are made and lost. Munger's fortune came not from being smarter than others, but from being able to act on his analysis when acting felt terrifying. As the market recovered through the late 1970s and into the 1980s, Munger's positions that had been underwater became enormously profitable. The businesses he'd bought cheap continued generating cash, paying dividends, growing their intrinsic value. The market eventually recognized that value, and prices followed. But even more important than the immediate returns was the positioning. By buying during the crash, Munger had accumulated large positions in excellent businesses at prices that meant even mediocre future performance would generate good returns. He built a portfolio that was almost impossible to screw up because the entry prices were so favorable. This is the compounding advantage of buying during crashes. You're not just buying lower, you're buying with such a favorable starting point that time becomes your ally rather than your enemy. Even if the business grows slowly, even if there are setbacks, even if management makes mistakes, you'll still do well because you started from such advantageous prices. The 1973-74 crash taught Munger lessons that shaped his investing philosophy for the rest of his life. These weren't lessons about stock picking or market analysis. Those he'd already understood. These were lessons about psychology, preparation, and what actually matters in building wealth. The first lesson was about preparation. Munger realized that your ability to profit from a crash is determined years before the crash happens. If you're fully invested when prices collapse, you can't buy more. If you're leveraged, you might be forced to sell. If you don't have cash reserves, a job loss or expense crisis during the downturn can destroy you. The time to prepare for a crash is during the boom. That's when you build cash reserves, avoid leverage, keep expenses under control, and maintain flexibility. Most people do the opposite. They maximize their market exposure during booms and have no dry powder when opportunities appear. By the time they realize they should have been more conservative, it's too late. Munger became even more disciplined about financial preparation after 1974. He always maintained substantial cash reserves. He never leveraged personal assets. He kept living expenses low relative to income, so that even a severe income drop wouldn't force financial decisions. All of this was preparation for the next crash whenever it might come. The second lesson was about temperament. Munger had always known intellectually that temperament mattered in investing, but experiencing a real crash hammered home just how much it mattered. Knowing what to do is useless if you can't force yourself to do it. And under the pressure of a collapsing market, most people can't. This made Munger more skeptical of purely intellectual approaches to investing. He'd met plenty of people who could analyze businesses brilliantly, but couldn't handle the emotional reality of market crashes. Their intelligence was wasted because their temperament wouldn't let them act on their analysis. Going forward, Munger paid as much attention to people's psychological resilience as to their analytical capabilities. The third lesson was about humility regarding timing. Munger had bought too early. His purchases in early 1973 and throughout 1974 had all declined significantly after he made them. If he'd somehow known the exact bottom, he could have made even more money. But he accepted that timing the bottom was impossible. What mattered wasn't buying at the bottom, it was buying when prices were attractive relative to value. If you waited for the bottom, you'd never buy because you'd never know the bottom was in until prices had already recovered. Better to start buying when things were cheap and accept that they might get cheaper. This lesson made Munger comfortable with dollar cost averaging during crashes. He didn't need to make one perfect purchase. He could buy over time, accumulating as prices fell, accepting that some purchases would look worse before they looked better. As long as the average price was attractive, the strategy worked. The fourth lesson was about independent thinking. The conventional wisdom during the crash had been unanimous. Get out of stocks, protect your capital, wait for stability. Every expert, every advisor, every commentator agreed, and they were all catastrophically wrong. Munger realized that being contrarian wasn't enough. You had to be correct in your contrarian thinking. But when everyone agrees on a financial question, the consensus is almost certainly wrong because markets don't reward consensus. If everyone believes stocks will go down, stocks are already priced for that belief. The opportunity lies in being right when conventional wisdom is wrong. This made Munger more willing to stand alone in his judgments. He didn't seek validation from experts or colleagues. He did his own analysis, reached his own conclusions, and acted on them regardless of what the crowd was doing. Sometimes the crowd was right, but those were also the times when there was no unusual profit opportunity. The fifth lesson was about psychological support systems. Munger had been able to stick with his strategy in part because he had Warren Buffett as a partner who saw the situation the same way. They'd reinforced each other's conviction, discussed opportunities, and provided mutual support during the darkest moments. Going forward, Munger became more deliberate about maintaining relationships with people who shared his investment philosophy. Not for social validation, but for practical support during difficult times. Having someone you trust who can help you reality test your thinking during a crisis is enormously valuable. The sixth lesson was about communication with family. Nancy Munger's support during the crash had been critical. She trusted his judgment even when the portfolio was declining month after month. That trust had required clear communication about the strategy, the risks, and the long-term thinking behind the decisions. Munger learned that financial decisions don't exist in isolation. Your spouse and family live with the consequences. If they don't understand what you're doing and why, their fear and anxiety can undermine your strategy, even if the strategy is sound. Clear communication isn't optional. It's necessary for successful long-term investing. The seventh, and perhaps most important lesson was about patience. The crash and recovery had played out over years, not months. From the peak in early 1973 to the bottom in late 1974 was nearly 2 years. From the bottom, back to the previous peak took another 3 years. That's 5 years of waiting for the strategy to prove out. Most people don't have 5-year patience. They want validation quickly, they need to see results soon, or they lose faith and change course. Munger learned that real wealth building happens over decades, and you have to be comfortable with strategies that take years to prove correct. All of these lessons compounded into a philosophy that served Munger for the next 5 decades. He went through other crashes, 1987, 2000, 2008, and his response was always the same. Prepare during good times, buy during bad times. Trust your analysis, ignore the crowd, be patient. Let compounding do the work. Understanding the emotional and psychological elements of Munger's success during the crash is important. But the foundation of his success was mathematical. The returns he earned weren't lucky. They were the inevitable result of buying good assets at depressed prices and holding them through recovery. Let's look at the simple mathematics. Suppose you bought a stock at $100 in January 1973. By December 1974, it had fallen to $55, a 45% decline matching the broader market. If you held through the recovery and the stock returned to $100 by 1977, you'd be back to break even. You'd have lost 2 years to the crash and 3 more to recovery, with nothing to show for 5 years of waiting. But suppose you had cash during the crash and bought at $55. When the stock recovered to $100, you'd have earned 82% on your investment. And that's just to get back to where prices were before the crash. Once the stock continued growing beyond $100, your returns from the low entry price became extraordinary. This is the mathematical advantage of buying during crashes. The percentage gain required to recover from a loss is always larger than the percentage loss itself. If you lose 50%, you need a 100% gain to get back to even. But if you buy at the 50% reduced price, that same 100% move gives you a double from your entry point. Munger's purchases in 1973 to 74 had even better mathematics because he wasn't buying the market average. He was buying excellent companies at crash prices, so he was getting businesses that would likely grow faster than average, bought at prices below average. That combination, above average quality at below average prices, is where the real compounding magic happens. Consider a concrete example. The Washington Post company was trading at around $28 per share in 1973. By the crash bottom, it had fallen to under $6 per share. Munger and Buffett recognized that the company's assets, its newspapers, television stations, and other media properties, were worth far more than the entire market capitalization. Even assuming conservative values for the assets and no growth, the company was worth at least $40 per share, more than 6 times the market price. This wasn't speculation or forecasting. It was simple arithmetic based on what someone would pay to buy those assets privately. When they bought at $6, they weren't predicting the stock would go to $40. They were observing that it was already worth $40, and the market was offering it for $6. The recovery wasn't about the business improving. It was about the market eventually recognizing value that already existed. By 1977, Washington Post stock was back above $28, nearly a 5x return from the crash bottom, in just 3 years. Over the following decades, it continued growing, and the original crash price purchases compounded into enormous returns. Not because of lucky timing or brilliant forecasting, but because they bought a dollar for 40 cents and then let time work. This is the mathematical secret behind buying during crashes. You're not trying to time a recovery. You're buying assets that are worth significantly more than you're paying, and then waiting for the market to eventually recognize that fact. Whether recognition takes 6 months or 3 years or 5 years, doesn't fundamentally matter if you have patience. The mathematical advantage compounds over time. Suppose you buy a business worth $100 for $40. Even if the business doesn't grow at all, once the market recognizes its value, you've made 150%. But businesses do grow. If that $100 business grows at 10% per year for a decade, it's worth $260. Your $40 purchase is now worth $260, a 550% return. The combination of cheap entry price and business growth creates returns that can't be matched by buying at fair value, even if everything goes right. Munger understood this mathematics viscerally. He wasn't hoping for good luck or betting on timing. He was stacking mathematical advantages, buying assets worth more than he paid, buying businesses that would grow over time, and buying with such a favorable margin of safety that even if he was partly wrong, he'd still make money. This is why he could sleep at night, while positions were declining. The mathematics didn't change just because prices were falling. If a business was worth $100, and he bought it for $40, it was still worth $100 when the price fell to $30. Actually, it was probably worth $102 by then, because the business had generated earnings and cash during the decline. The lower price just meant the market was offering him an even better deal if he had cash to buy more. Most investors can't think this way. They conflate price with value. When the price falls, they assume value has fallen too. But that's not how business value works. The value of a great business comes from its ability to generate cash over decades. A market crash doesn't change that ability. It just changes what people are willing to pay for it temporarily. Munger's mathematical edge wasn't in having better financial models or more sophisticated analysis. It was in understanding the fundamental principle that price and value are different things, that they disconnect during crashes, and that the eventual reconnection is mathematically inevitable if you've correctly assessed value and bought with an adequate margin of safety. The returns he earned from crash purchases weren't lucky outliers. They were the mathematical result of buying dollar bills for 40 cents and waiting for Mr. Market to eventually correct his pricing mistake. Charlie Munger experienced many more crashes after 1973 to 74. The 1987 crash, the 2000 dot-com collapse, the 2008 financial crisis, the 2020 pandemic sell-off, each one different in cause but identical in pattern. Prices would collapse, panic would spread, and opportunities would appear for those prepared to buy. And each time Munger did essentially the same thing he'd done in 1973. He stayed calm. He evaluated businesses rather than predicting markets. He bought when others were selling. He waited patiently for recovery, and he made money while most investors lost. The 1973 to 74 experience had taught him that crashes are features of markets, not bugs. They're inevitable, unavoidable, and actually necessary for maintaining market efficiency. Without crashes, there'd be no mechanism to correct overvaluation. Without fear, there'd be no bargains for rational investors to exploit. This perspective made Munger financially comfortable with crashes even when they were psychologically uncomfortable. He didn't enjoy watching his net worth decline any more than anyone else did, but he understood that temporary declines were the price of admission for long-term returns that beat almost everything else available. More importantly, he understood that the next crash was always coming. Not next year necessarily, maybe not for 5 years, but eventually, inevitably, markets would decline severely again. And when that happened, the people who'd prepared would profit while everyone else panicked. That preparation had several elements Munger emphasized consistently. First, maintain dry powder. Always have some cash or cash equivalents available to deploy during crashes. Not so much that you miss the compounding during normal times, but enough to be a meaningful buyer when opportunities appear. Munger suggested 5 to 20% depending on your circumstances and outlook. Second, avoid leverage. Leverage turns market crashes from opportunities into disasters. If you're borrowing to invest, a crash can force you to sell at the worst time. Munger never used margin for personal investing and avoided it in business whenever possible. The cost of leverage isn't the interest rate, it's the loss of flexibility during downturns. Third, keep fixed expenses low. The less money you need to extract from investments to live, the more freedom you have during crashes. If you can survive indefinitely without selling, you can wait for recovery however long it takes. If you're depending on portfolio income or have high fixed costs, a crash can force irrational decisions. Fourth, prepare psychologically. Study previous crashes. Understand how you'll feel when it happens. Accept in advance that you'll experience doubt, fear, and social pressure to sell. Having realistic expectations about the psychological difficulty makes it easier to stick with your strategy when the time comes. Fifth, develop a philosophy and stick with it. Don't try to be tactical, timing when to be in or out of markets. Have a consistent approach to valuation, and buy when your metrics say things are cheap regardless of what the market is doing. Munger bought based on value, not based on predictions about market direction. Sixth, focus on quality. During crashes, everything gets cheaper, but quality businesses recover and grow. Lower quality businesses often don't survive. The recovery period sorts winners from losers, and you want to be holding the winners. Pay up for quality during normal times, and that quality will protect you during crashes. Seventh, think in decades. If you're investing with money you need in the next few years, crashes are dangerous. But if you're building wealth over 20 or 30 years, crashes are gift opportunities to accumulate assets cheap. Your time horizon determines whether crashes help you or hurt you. Munger believed that the 1973-74 crash had given him a permanent psychological advantage. He'd lived through one of the worst crashes in history. He'd bought during the panic. He'd watched his positions decline. He'd felt the doubt and fear, and he'd come out the other side wealthier and wiser. That experience meant future crashes didn't shock him. He knew what they felt like. He knew how his emotions would react. He knew that the pain was temporary and the opportunity was real. Having been through it once made it easier to handle it again. This is why Munger encouraged younger investors to study financial history obsessively. You might not experience a severe crash until you're 40 or 50 years old, but if you've studied the crashes of 1929, 1973, 1987, 2000, and 2008, you're not encountering the pattern for the first time. You're recognizing something you've studied and prepared for. The next crash will come. It always does. The cause will be different. Maybe a war, maybe inflation, maybe a debt crisis, maybe something no one's currently worried about. But the pattern will be identical. Prices will collapse. Fear will spread. Conventional wisdom will say stay out of stocks. The media will amplify the panic. Your friends and family will think you're crazy if you're buying. And that's when you'll make the choice Munger made in 1973. Either you'll buy when others are selling, or you'll sell when you should be buying. Either you'll stick with your strategy, or you'll abandon it under pressure. Either you'll be patient, or you'll panic. The choice is binary, and it will determine whether the next crash makes you wealthier or poorer. Munger chose to buy. He chose patience. He chose to trust his analysis over the crowd's emotion, and it made him one of the wealthiest people on earth. The opportunity will come again. The only question is whether you'll be ready when it does. Will you have the capital? Will you have the courage? Will you have the preparation? Will you have the patience? Because crashes don't destroy wealth. They transfer it, from the panic to the patient, from the emotional to the rational, from the people who sell to the people who buy. The next crash will create fortunes. The question is whose fortune it will create. Will it be yours? That's the lesson from 1973. That's the lesson Munger carried for 50 years. And that's the lesson that applies to every crash that will ever come. The question isn't if it's when. And when it comes, will you do what Munger did? Or will you do what everyone else did? The choice, as always, is yours.